You're listening to the Stock Detective Podcast. I'm Kermit Capital. On this episode, Deval and I prepared a deep dive on Amazon, which is a company that both of us have personal experience with. We're excited to share our unique perspectives on this company. We've also included a link to the slide deck we use in this episode for anyone to read through, leave questions or comments on. Now, before we get to the episode, here's a quick disclaimer. This podcast does not constitute an offer of or solicitation for purchase or sale of securities or provision of any investment services. It is provided for information only and should not be considered as investment advice or recommendation to buy, sell, or hold a particular investment. You're responsible for your own investing decisions. All right, here we go. Welcome to the Stock Detective Podcast. I'm your host, Kermit Capital. I'm joined by my co-host, Deval Kotecha. Deval, how are you doing today?
Good. How are you?
Awesome. I'm looking forward to do this episode with you. We've been working on this one for quite a while. Today is our deep dive on Amazon. I wanted to talk a little bit about why we wanted to cover Amazon and what our experience is as individuals with Amazon. And I'll just get started. So I have a degree in industrial and systems engineering, and my first job out of college was working in operations at Amazon. And when I worked there, I was paid via stock-based compensation. From my experience working at Amazon, I really gained a lot of conviction about the company over the long term. And it's the first company that I actually held shares in as an active investor. And I've never sold a share. It's a 10-bagger for me. And it's 20% of my portfolio. And I'm still excited about this business for the long haul. So I'm excited to go over this company with you, Deval, and I'd love to hear your experience with this company as an investor and in your personal life.
Yes, absolutely. So for me, it was one of my first 5 investments, and I have never sold a stock since then. And I have been a very happy shareholder. I predominantly invested in Amazon based out of my experience on AWS. My background on AWS is I'm a AWS certified solutions architect, and I work at a company where we deploy all our applications on AWS. And it was so good to see how easily you could do stuff that would take you a very long time if you had to build your own infrastructure.
Awesome. And then, I know by myself, I'm an Amazon Prime member and I order on Amazon relatively frequently. I'm wondering if you do too.
Yes, it's the same case. Yep.
Yep. All right. So let's dig into it.
All right. So I just wanted to talk about Amazon, just give a brief stat on Amazon, like 800,000 employees and around 1.5 trillion market cap as of market close. And one thing that I like about Amazon is Jeff Bezos. And I like his long-term thinking and him maintaining high standards. Like he talks about that in the shareholder letters. And also a big fan of the ways how Amazon operate, about their operational excellence. Like those are like the big things that I like in Amazon. What about you?
Yeah, so as someone who worked there, and this is something we're going to probably cover later, is the biggest one of the biggest takeaways I have from working at Amazon is that their strongest competitive advantage is their culture, not just like what's written down in their culture, but how they execute and how they spread the leadership principles and the operating strategy at Amazon. It's like you said, 800,000 employees around the world. And the fact that you could pull any employee aside, and you'll hear a very similar vision for how the company operates is a pretty remarkable thing, especially having had worked at other companies, other lesser companies that aren't as effective in this area. Yeah, so that's the biggest advantage I see them having over the long term.
Yep. And one more thing that I missed was the customer obsession. That is the biggest thing, because they are the Earth's most customer-centric company, and how
Mhm.
can they not care about their customers? I have never seen any other company who cares about their customers in such a big way.
Yep.
Yep. All right. So, do you want to give a introduction on how it all started?
Yep. So Amazon was founded in July 5th, 1994 in Seattle, and it IPO'd in 1997. But before we get into Amazon, actually, I wanted to just make a quick note of Jeff Bezos' history before working at Amazon. So he had a degree from Princeton in electrical engineering, and his first job, or his job before working at Amazon, was working at a hedge fund called D.E. Shaw, out of New York, which is still around. And he was an investment manager, investment analyst. I'm not quite sure, but the point that I'm trying to make with this experience is I believe that it's a major influence into how he operates at Amazon. The operating principles and the way he communicates to shareholders, focused on the long term, reinvesting capital back into the business, and being consistent with his messaging since the IPO. So one fun fact about Amazon regarding the shareholder letters is that at the end of every annual shareholder letter, he appends the 1997 shareholder letter as a way to sort of keep himself accountable to being consistent over time. And I think that's pretty rare for CEOs to do. And I think he's definitely set the standard for like this type of communication, being this transparent and being this consistent over time.
Yep.
Yeah. And any thoughts on any of that?
No, I just wanted to highlight here that he started very small. He started with the Amazon.com books, and that was what his initial idea was. And then now we all know how it went from there. And he left a pretty high paying salary to start this business, right?
Yep. Yep. And a couple other things while we're looking at this slideshow. People might already know this, but the idea behind the name Amazon.com is a reference to the Amazon River. With regards to like how wide the selection he envisioned, and how deep it would run, and how far it would go. So the world's largest river. And working at an Amazon fulfillment center, there is literally like a river of packages that flow through the fulfillment center. And an alternative name that they had for Amazon.com is Relentless.com. Actually, if you type Relentless.com in like any browser, it'll redirect you to Amazon.
Yep.
And then another thing here is you'll see in this picture on the top right corner, this is Jeff Bezos working on at his desk in the early days of Amazon, and it looks kind of like frankly an ugly, dirty desk. And what it is it's a door desk. And so what he's so frugal, he's so cheap with like the company's money that they would take doors and then put some plywood underneath and then turn those into tables instead of just buying desks, for the office. And I worked at Amazon, from 2011 to 2014, and the tables and desks that I used at my job in a fulfillment center, 10, 20 years later or whatever it was also door desks. So they've been consistent about that as well.
That's a great thing to hear. I didn't know that.
Yep.
So let's go in the history of Amazon.
Mm-hmm.
If I see Amazon was founded in 1994, and it IPO'd at $18 a share in
Mm-hmm.
1997.
Yep.
Um, do you want to go about like the company milestones and the product launches and the acquisitions
Yeah.
they have made so far?
Yep. So you can see a lot of the milestones here. I think some of the big ones for me are the Kindle ebooks outselling hardcover books is a huge milestone, not just at Amazon, but just for the world in general. That there's this push to digital transformation and how we consume books. The first physical store is another one, and the 15-hour minimum wage. We're going to talk about sort of why that's important later. As far as product launches, the Kindle launch is huge. Kindle Fire, which a lot of people would view as Amazon's biggest failure, the Fire phone, launching around that time. Amazon Prime Air, which is Amazon's push into more of the logistics business to free themselves up from FedEx and UPS. And some of the things we're going to cover more deeply are Kiva Systems, Twitch, and PillPack, with just a little bit more. So, and you wanted to touch on one other one as well, right?
Yep. So I wanted to talk about the EC2 here, Amazon Elastic Compute Cloud. This is the AWS part, and Amazon S3. That's the storage layer, and EC2 is the compute layer. So as we all know, AWS was a game changer for Amazon, and they launched somewhere around 2006 here. And I also wanted to talk about acquisition here, which is the Annpurna Labs acquisition. This is the least known of the acquisitions here. Nobody talks about it. This was what was a game changer for AWS, that helped propel them to new heights. So yeah, overall, like I like the acquisitions here. Kiva Systems, which is Amazon Robotics, Twitch in the gaming side, and PillPack in the healthcare space.
Yep. Yeah. So let's move on to the next slide.
Yep.
Yes.
So
yeah, go ahead.
so as you can see here, I got this from iterate.ai. This is a brilliant graphic made by them. They truly say that Amazon is a complex ecosystem. It's not just a company. And as you can see, they have a lot of business units here. They have like 43 subsidiaries, if you see on the right. And they have the big chunk as the retail space. They have a big chunk of revenue coming from AWS, a lot of Prime, advertisements, esports, finance, healthcare. Where is Amazon not in? That's the question to ask here.
Yep. And one other footnote about this page, also, if you look at the bottom right corner under grocery logistics, is a company called Webvan Group. And just looking up online, Webvan Group is the online grocery delivery service that operated between mid 1999 and mid 2001, when it ceased operations and shut down due to just bankruptcy. And so I think that's just an interesting tidbit that they're somehow still a subsidiary of Amazon now.
Right. And not to talk about like this Ring devices, they recently launched. They launched a drone, which is there in your home. They are trying to capture that market as well by their private label IoT devices. So yeah, they are everywhere. Entertainment, you name it, right?
Yep. So I think we have a quote that we wanted to set up the next few slides. Why don't you read this one?
Yep. So this is a quote from Scott Galloway from his book, The Four, The Hidden DNA of Amazon, Apple, Facebook, and Google. And this mostly pertains to the retail space, where he says Amazon is going underwater with the world's largest oxygen tank, forcing other retailers to follow it, match its prices, and deal with the changed customer delivery expectations. The difference is other retailers have just the air in their lungs and are drowning. Amazon will surface and have the ocean of retail.
Yep.
So what do you think about this?
Yeah, I think that it scratches the surface, actually, because it's, they're talking about forcing others to follow it, matching its prices and delivery expectations. But I think one of the things we're going to cover is they are also pushing their competitors into stakeholder, values. So paying a livable wage, providing better benefits, keeping the climate change at the top of their priority list, pressuring other companies to do more. for stakeholders. So I think they're doing this like all across a bunch of different dimensions.
Yes. And talking about the customer delivery expectations, who would have thought you would get the same day delivery uh, right at your doorstep, right? That was
Yep.
something that Amazon was at the forefront of making that happen, right?
Yep. Absolutely.
All right. So this is what we are going to deep dive in. These are the two businesses, Amazon's e-commerce and AWS. We'll start with Amazon and then we'll follow up with AWS and other businesses like advertising and stores. We talk about it in a small part.
Hmm.
So why not we get started with the e-commerce?
Yep. Yep. So this is the virtuous flywheel at the core of Amazon that Jeff Bezos used to sort of get everyone aligned on the vision and the mission of the value prop of Amazon. It all starts with the customer experience on the right. So it's, the goal of the company is to be Earth's most customer centric company. But how do you do that? There are certain ways to go about doing that. So if you start off with lower prices and good selection, you're going to provide a great customer experience. And by doing that, you're going to get more traffic. With more traffic, you're going to attract more sellers. And with more sellers, you're going to provide more selection and a better customer experience. At the same time, you're going to be able to provide a lower cost structure, which you can be passed on to customers as a lower price and a better customer experience. So it's a pretty simple model and pretty straightforward goal that they're going for. But how you do it is obviously not a trivial task.
Yes.
Yep.
Yep. So we had a question from Twitter where Tim Tom at bitu_1122 writes, I would like to get your guys' take on competitive landscape as other e-commerce companies gain traction, Etsy, Walmart, and Shopify. I know there can be more than one winner, but what does this entail for Amazon's moat? Do you want to talk about this in terms of this flywheel?
Yep. And it's important to just to reiterate, this is just the e-commerce retail side, right? We have the AWS side, we have Amazon advertising. There's a lot of competitors for Amazon. But if we're thinking about retail in particular, I think it's helpful to look at the competitors in relation to this core vision of Amazon. And so we'll start on the left with Shopify and Etsy. So I think, when you think about the strategy of Shopify, for example, they might have looked at the Amazon value proposition from the perspective of sellers and said, hey, I don't think sellers only care about getting traffic. I mean, obviously traffic is important and being able to sell large volumes of, their product is important. But I bet that customer or sellers care also about maintaining their brand, maintaining their customer relationships, owning the whole cycle or experience for customers, and they've been phenomenally successful with that. And then with Etsy, I think you have a similar thing. You have an optimized seller experience, and with happy sellers, you're going to eventually have happy customers. On the other side, on the customer experience assumptions, a company like Stitch Fix, and I know that this is a more controversial company in terms of whether or not this is a good investment. But disclosure, I own shares in Stitch Fix. I also own shares in Shopify. I think you own shares in Etsy and in Shopify, right?
Yes. Yes.
Yeah. So for Stitch Fix, I think they look at the assumption that customers only care about lower prices and selection and say, hey, I think that there's changing customer tastes and there's a segment of the population that will pay a premium for optimum product discovery. And I believe that's a winning strategy over time. If you have a ton of SKUs, if you have a ton of items to sift through, I think it makes sense to have a service that helps you sift through the noise and save you time and expose you to brands that you would have not otherwise had the opportunity to find or wouldn't have thought of yourself. So that's why I like Stitch Fix. And I should also preface this by saying I don't think any of these competitors here are going to pose an existential threat to Amazon. But I think that there's room for more than one winner in the e-commerce retail space. I think that's pretty obvious. Any thoughts on your end about
And
this?
that's absolutely true. Very much fair to say that. Etsy, again, like I would want to highlight here, it's a very specialized kind of a platform, which is like Amazon tried to compete with Shopify. Amazon tried to compete with Etsy. It was not successful
Mm-hmm.
here because they both operate in a very different space. So moving on to the operational efficiency side, I'm going to talk about a parameter which nobody normally talks about when quoting Amazon, and that is the cash conversion cycle. Do you know what a cash conversion cycle is?
I think after talking to you, I have a better idea, but I'd love to hear you walk through this again.
Okay, so for ease, what I've done is I have provided this formula here. Cash conversion cycle is days sales plus days inventory minus days payable. What does these parameters mean, right? So days sales are how long it takes to get paid by the customers. Days inventory is how long it takes before company like Amazon sells that item um, that they have sitting on the store or the fulfillment center. And the days payable is how much time they have before they are due to their suppliers, right? So this metric, overall metric, cash conversion cycle, it will show how many days it takes to sell an item, get paid, and pay the suppliers. Lower the number is better because in that case, you get to keep that money and fuel the growth of your company. And this is one of the metrics that measures management's effectiveness. What I did was I compared the four companies which are in the retail space, namely Amazon, Costco, Walmart, and Target. And I was curious to see what their cash conversion cycles looked like.
Mm-hmm.
And what I found was Amazon, the cash conversion cycle is minus 16.07. So what this means is Amazon has 16 days to keep that cash and put that money back in that company to fuel the growth because they are not due for 16 days to pay the
Mm-hmm.
suppliers, and this is the flywheel that keeps on going. And they have been able to successfully do this for years. Like I have not seen this value go down above zero for
Mm-hmm.
Amazon ever.
Mm-hmm.
In comparison to Costco and Walmart, you see like positive numbers here. That means they are due to the suppliers much before they get paid for that item. Like Walmart is barely like in negative. Target has done a pretty good job at -7, but Amazon is the leader here at -16.
Yeah, I'm so glad you put this together and shared this because as someone who's owned Amazon stock for a long time now, I was oblivious to this personally, and I think having gotten a little bit more exposure to Warren Buffett and Berkshire Hathaway, my mind goes to like one of the key strategies of Berkshire Hathaway, which was to have this insurance business where they're collecting, revenue from their customers that they don't have to pay out for a while, and then in that buffer period where they don't have to pay out the customers, they use it and reinvest it in other companies or other businesses. And so in that way, that's something that just came to mind when you explained this to me on the Amazon side.
Right. Yep. And like I have been so impressed by Amazon's efficiency, like the management effectiveness since the beginning.
Mm-hmm.
Uh, and there's one more example of this effectiveness where I want to talk about this thing where in their annual shareholder letters. They have the lease square footage and the own square footage breakdowns for North America, International, and AWS, and you can see how much of the square footage that they lease compared to their own, right?
Mhm.
You want to talk about it?
Yeah, yeah. If you look at it on the North America, if you just compare North America to AWS, you'll see a huge discrepancy, as you mentioned. It's like looks like a 1% ish of the square footage is owned in the North American retail side, versus maybe like a third of AWS square footage is owned. And having worked on the e-commerce side, in the fulfillment side, just to give people some context. The building that I worked at Amazon was about 1.5 million square foot facility. So it's an enormous facility. But when you look at the total lease square footage being, what is it, 200 million, it gives you an idea of how many fulfillment centers there are in North America, somewhere between 150 to 200 fulfillment centers as of this 10Q that we pulled this from. And when I worked at Amazon and went through corporate training, they made a point to tell us that their fulfillment centers are leased and not owned. And when I asked like why that is, their response to me was that they don't do real estate very well, which to me seemed like a kind of like a disingenuous answer to that question, to be honest. Some of the benefits that I see are flexibility, being able to shut down a fulfillment center or spin one out, start a new one, relatively quickly without having the burden of what you'd have to do if you owned the square footage. And I think you had some thoughts on the international side, if I don't
Yes.
if
So
I
on
remember
the
correctly.
international side, you have restrictions or regulations, as I might have to talk about, where if you go in another country and if you have to buy your land for, say, fulfillment centers, then it's much easier for you to go and lease and be much more nimble and go faster compared to going into the real estate world where you will have to go and buy that and go through those regulations and then wait for it to be passed by the government of that country and then move ahead with your fulfillment,
Mm-hmm.
right?
Yep.
um, so yeah, let's get into some numbers in terms of revenue, what Amazon does report in the 10K. Um, the net revenue, what I have done is I have taken 2014 to 2019 numbers, and they have these numbers by product group: online stores, physical stores, retail, third-party seller services, subscription services, AWS, and other. As you can see, the numbers are heading in the right direction. So do you want to talk about the online stores, retail, third party, subscription, physical stores, and I will take the AWS and the other segments?
Yeah, and by the way, beautiful slides. Thanks for putting these together. These are awesome. So on the online stores versus retail third-party seller services, if you look at the 10K and look at like the description of these, the retail third-party seller services are mostly fulfillment by Amazon, and this is where a supplier or seller will pay fulfillment costs to Amazon to fulfill their orders for them. And online stores are more of the inventory in the fulfillment centers that are managed by Amazon themselves, as well as the digital services that they sell to consumers. So digital media, books and movies and music and that kind of thing. Physical stores are more of the Amazon Go type of stores, Whole Foods, that have been spitting out or that they bought not too long ago. And then subscription services are Amazon Prime subscription revenue, which is at 20 billion as of 2019. Yeah, do you want to talk about AWS?
AWS is pretty evident here. That's the business that comes from AWS. Revenue comes from AWS, and you can see from 2014, from $4.6 billion, it has now become like $35 billion, the third biggest contributor to Amazon's revenue in terms of dollar amounts. And this other segment is the one which is growing at a much faster rate, like 1.3 billion in revenue in 2014 to 14 billion in 2019. Now, what does other comprise? It's advertising business. So if I want to sell anything on Amazon, I can use their DSP or any of their advertising services and pay Amazon to show my ads to the buyers, potential
Yep.
buyers.
Yep. Yep. Yeah, let's move on to the next slide. Awesome. So here we have year over year numbers for the Amazon revenue, which you can see the year over year growth percentage as well. One quick thing to note is the drop in physical stores, and with coronavirus, there's been a halt in certain segments of the physical stores, which is causing some of that year over year growth decline. But along the lines of that other segment growing at 40%, that's another thing to keep an eye on, that Amazon advertising year over year revenue growth.
Yep. So total year over year growth was 40% for the quarter ending in June 30, 2020. Um, so if we had to move to the next slide, these are the net sales in million, operating income loss in millions, and operating margin. I wanted to highlight this. So the net sales for the North America region increased here. International also saw uptick, and AWS also saw uptick from 25 billion to 35 billion here. But the operating income, if I see, the operating income went down in the North American segment. The loss was a little bit lower for international, and operating income was higher for AWS. So if I had to see the operating margin based on like the net sales and operating income here, I see that the operating margin for the North America segment in 2018, it was 5.14. 2019, a slight drop to 4.12. International from minus 3.25 to minus 2.27. But if you see the biggest contributor here, AWS margins pretty phenomenal, like at 28.44 in 2018 to 26.27 in 2019.
Yep. Yeah, and I think the top two slides, if you focus particularly in the North America AWS on the top left and the top right, it tells a story. You know, see all the revenue that needs to be generated in North America on the retail side or the e-commerce side. So that's 170 $170 billion, generates $7 billion of income, versus AWS, generates $35 billion of revenue, and then $9 billion in operating income. So it's huge. The AWS revenue is very high quality revenue. And so I wanted to talk about the regions on the bottom right corner here. And you can see that the U.S. Or North America segment is a huge contributor to the revenue on the e-commerce side, and then some of the other major contributors are Germany, UK, and Japan. And then everything else is put in the rest of world bucket. And I think the first question that comes to mind, if you're an active investor nowadays and looking at e-commerce retail on a global scale, companies like, C Limited and Mercado Libre, We mentioned Reliance Joe, and Tencent, Alibaba, JD.com. Those are the companies that kind of come to mind, and you have to wonder, has Amazon allocated their international, spend appropriately? And if you look at C Limited's retail revenue on an annualized basis, it's about $2 billion. And same thing with Mercado Libre, they're around $2 billion. So when you compare that to the the $22 billion in Germany last year, the $17.5 billion in the UK, and $16 billion in Japan, while Southeast Asia and Latin America have a ton of green space ahead, it's hard to say that Amazon, misallocated their resources when you look at this graph.
Right. But the rest of the world is still an opportunity for Amazon, specifically in countries like India,
Mm-hmm.
where it is making inroads. And I would like to see these numbers go up,
Mm-hmm.
and eventually to be at a level where there would be a separate section for a country like India.
Yep. Yeah. And we talked about this before we started recording, but, I think that in general, it doesn't seem like very many international companies have been successful, in China. But I think that both of us feel as though Amazon has a real shot to maybe not own the market in India, but get a substantial foothold in India and generate meaningful revenues profitably there. So I think both of us, that's part of our thesis long-term moving forward.
Yes, absolutely. So we have a couple of questions from Twitter. Duarte at Friday Duarte. He says, how big is too big? And Phil Herner at Phil Herner. He says, can such a large company continue to grow at its current rate? So what do you think about this?
Yeah. I think that this is a good question. I think this is the question, in terms of like, should you buy more Amazon shares? And I think, the way I look at it, and I'd be interested to get your opinion on this, is $1.5 trillion sounds like a lot. Apple's around a $2 trillion valuation. We're talking about the largest market caps of any company of all time. But at the same time, if you think about the environment that we live in today, how ubiquitous smartphones are, the rise of 5G and just really great internet access, the frictionless e-commerce experience, the ability to start a business on, start a website or an online business on AWS with no hardware. We're living in unprecedented times. And I think that, Jeff Bezos is only 56 years old. And you have a very powerful company with many possible paths ahead, a lot of optionality, a lot of cash on the balance sheet, and a long history of swinging for the fences and making and hitting some grand slams. I think AWS is a really good example. So how big is too big, and can it grow larger? I think that Amazon in 10, 20 years will be multiples higher than it is today. I'm betting that it'll become a 15 trillion, $20 trillion company at some point in the future, which might be hard to wrap your head around. And, this isn't investing advice, so do your own due diligence, but that's where I stand with it.
Yes, and I do think they have a lot of runway to grow. If you consider the media, right? So you have Amazon Prime Video, and a lot of content in India now, because the movie theaters are now not open because of COVID, and people are not comfortable going there. A lot of movies in India, a lot of production studios have uh, join hands with Amazon Prime Video to release their movies. Now, media is one part, Prime delivery is one part, e-commerce is one part. Now, if you have these main segments to yourself, then sky's the limit for this company. And I would say Amazon has become a way of life for a lot of people, and for whoever it has not yet become, it
Mhm.
will become a way of life in the coming future.
Yeah. And one other point that I'd like to make, and we could go on and on and on about this, but if you look at the big tech companies, Facebook, Apple, Amazon, Google, a few other ones, the only founder-led companies of those at this point are Facebook and Amazon. And if you follow me on, Twitter, you know that I hate Facebook, and I think they should be regulated and broken up. And I'm skeptical of the business, although it could be a great investment. I think that Jeff Bezos, on the other hand, is a stakeholder focused leader, and I think that he has a long track record of really doing a phenomenal job of growing this business, and I have no reason to believe he will stop doing that. So I think we both love founder-led companies, and I think that's you'd be hard pressed to find a better capital allocator in the history of business than Jeff Bezos.
Right. And talking about this, one thing that I didn't mention was AWS.
Mm-hmm.
So let's move on to the AWS segment, where I want to highlight the Magic Quadrant for cloud infrastructure and platform services. Um, so as you can see here, these are the top three players. Amazon Web Services is the number one player currently in the market, with Microsoft and Google close second and the third players. And the other niche players are Alibaba Cloud, Oracle, IBM, and Tencent Cloud. But you can see here how far Amazon Web Services is in the leader segment in this Magic Quadrant by Gartner. Uh, I just wanted to give a perspective on how big Amazon Web Services is and how much the other big companies are spending on Amazon Web Services. These are the list of their top 10 customers here: Netflix, Twitch, LinkedIn, Facebook, Turner Broadcasting, BBC, Baidu, ESPN, Adobe, and Twitter. These guys spend over like millions of dollars, like $19 million of just monthly EC2 spend. EC2 spend is just the compute capacity spend. There are a lot more other costs when you are just adding to the EC2 spend, but these are just the numbers for EC2: $19 million, $15 million, to up to like $7 million. These are like monthly spend numbers. These companies are not going anywhere outside Amazon Web Services. These are well-established companies. And if you see, there are other smaller companies like Slack and Airbnb, which operate on Amazon Web Services as well. Microsoft and Google are catching up here to Amazon Web Services. Microsoft and Google are doing well. There are a few reasons to it. One primary reason is, if I am a target and I'm competitor to Amazon, then I'm not going and having all my business go to Amazon Web Services. I will go to someone who is a competitor to Amazon Web Services, which is either Microsoft or Google, or maybe Oracle Cloud, where TikTok and Zoom are right now. Do you have any thoughts about this?
Yeah, on that last point, I think that there's the structural sort of bifurcation where it's saying like certain industries, like you said, are going to probably gravitate towards the cloud platform that is not competing with their business directly. So you mentioned like Target, for example, going on Microsoft. I'm not sure which. Did you say that Walmart's on Google's
Yes, Walmart has
platform?
partnerships with Google. I think Target was on AWS and is now on Microsoft.
So you can kind of see like the retail players are wanting to get off of Amazon, but which companies are not wanting to be on Azure or GCP? You know, these are your you know, Slack, Adobe type companies, which have generally better growth prospects over the next 10 to 15 years and better unit economics, and they can afford to pay higher fees to be on these cloud platforms. And then if you look at the general industries that you see in this big spenders, you see streaming platforms, you see social media companies, you know, you see SaaS companies. You know, if you think about the next 10, 15, 20 years, you know, that's where the growth is, that's where the margins are. So I think that that's a really bullish sign for Amazon Web Services moving forward, even though Azure has caught up recently.
Right. And if you look at LinkedIn, right,
Mm-hmm.
that's a very curious case here, because LinkedIn is owned by Microsoft right now, but it is the third highest monthly EC2 spenders on Amazon.
And that speaks to, and you would know this better, that speaks to the stickiness of
Yes.
building on one of these cloud platforms and the moat. So Microsoft, I'm sure, would love to, in theory, move LinkedIn to Azure, but it's easier said than done.
Right. There are a lot of cost and a lot of effort that goes to migration, and it's not as easy as migrating um, other stuff compared to like this entire company, right? So they have a lot of stack, and they need a lot of effort to do that.
And one quick observation is Netflix being the number one spender on monthly EC2 spend. You know, when you compare that decision where Netflix is competing at the same time with Amazon Prime Video, but made the strategic decision to stay on AWS. You know, in comparison to the retailers who are not willing to make that leap. I think that Reed Hastings, you can kind of like applaud him for taking a gamble that really ended up working out. I think his vision was that Amazon ultimately will not want to you know, ruin the relationship there at the expense of the high quality AWS revenue that they're
Yes.
pulling in.
Yes.
And Reed was right.
Yep. All right. So let me give a brief overview on AWS. So this is AWS in a nutshell. They have 24 launch regions with multiple availability zones. I'll talk about what availability zones are. They have 3 more announced regions coming very soon, 77 availability zones, and serving 245 countries, 97 direct connect locations, and 216 point of presence. Um, Let me open up the infrastructure.aws to show what it really means. So you have the regions, which is like the big areas, like a country. Like you have the regions in United States. You have 3 regions here. Um, and you have multiple availability zones within those regions. So think of availability zones as like zones which are spread too far across, that if there is any catastrophe, then those are not impacted. Uh, Even if one availability zone goes down, the other availability zone in the same region is not impacted. And then you have data centers within those availability zones. And then you have POPs, which is the points of presence. This website, infrastructure.aws, is what will give you an idea about all these regions. So if I click here, it will tell you exactly what regions are, how many availability zones are within the region, gives you an idea about the data centers, gives you an idea about like how many points of presence are, what is point of presence, and also talk about their network. I just wanted to compare this with Azure geography here, and they have around the same number of regions. in terms of spread across the entire world, um, and comparing the global locations of Google Cloud, similar number of regions, 24 regions and 73 zones.
I think, it has to be said, like AWS's landing page for the global cloud infrastructure is just so much more cool than Azure and Google Cloud in
Yes,
terms of these maps. I mean, it's no competition.
yes.
It looks so ugly and stupid compared.
All right. So I would also want to talk about these two companies here when I specifically talk about the POPs or the point of presence. You will see a lot lower number of POPs here for Fastly, and a lot of points of presence for Cloudflare. It's the way they operate, very different. But again, with AWS, they do have the same thing. Points of presence, which will bring them very close to the customers. CDN, Fastly and Cloudflare, much more than just the CDN. No competition at all on that CDN front because Amazon themselves use Fastly on their website. So yeah, going back to these slides. This is a beautiful visual from our Twitter account, AWS Geek. And you see there are these regions highlighted. The first region, Northern Virginia, back in 2006, that's where it all started. And they kept on adding these regions across the entire world. And there are 3 regions coming up very soon: Osaka, Spain, and Jakarta. Osaka 2021, and Spain and Jakarta in 2022. Um, so moving on to the next slide, I just took the screenshot of all the available services in AWS, and I just wanted to give you guys a highlight on like how many such services are there and what all services fall under what category. These orange boxes are the ones which I have had hands-on experience in within the AWS. But if you talk about like say compute high level services, like compute is one of the main ones. Like EC2 is the Elastic Cloud Compute. Storage is their S3 simple storage service. They have the database, RDS, DynamoDB, Elasticache, a lot of management and governance stuff, analytics, application integration here, and it just keeps going. So networking and content delivery, developer tools, security, identity and compliance, and containers. And they are constantly adding new features on a weekly basis. And it is so phenomenal to see how fast they go in adding these services. The other thing that I wanted to talk about was the move from KPEX to OPEX. This is what propelled AWS to the new heights. What does KPEX and OPEX mean here? KPEX is your capital expenditure, and OPEX is your operational expenditure. So before AWS, what happened was you predicted the demand, and then you set aside money to buy the infrastructure. So you had to do the procurement, and then you had to hire people who could build those data centers and do networking and make it available to you. And that was a very, very slow process. So if you look at this chart, the dotted lines is the predicted demand here. So this is what we think it would be the demand, or the client would think this is what the predicted demand is. The blue heavy line is your traditional hardware, and actual hardware is the green line, and the automated virtualization is the orange line. So just talking through this particular chart, this is the predicted demand. The company goes and does the large capital expenditure here, and then it will stay at this until they figure, okay, now we need to scale back up, and then they are kind of scaling it in this fashion. What happens is this is the actual demand, and in this scenario the actual demand is much less than what you have provisioned your hardware, and this is the opportunity cost where the hardware is underutilized, and because your actual demand is much more less than what your hardware can serve. But if you go much further, then what happens is at this point the actual demand exceeds your infrastructure, and this is the area where you are unable to serve the customers, leading to like poor customer service and satisfaction. And at this point you are trying to scale your hardware. But with the cloud or with AWS, what it has enabled is your hardware to be added based on your demand, right? So you don't have to do any sort of capital expenditure. You don't have to worry about managing that hardware. You don't have to worry about infrastructure. You don't have to worry about anything related to network. And that's where they say it as infrastructure as a service, where they are providing you all the tools. You just worry about your application, and all the stuff is taken care by your companies like AWS and Azure and GCP. Um, so this is some sort of auto scaling, which you can configure within the AWS environment, where you can set, okay, if my demand goes high, then I need to scale my infrastructure. But if my demand goes down, then I would want to scale down my infrastructure. And you pay by the second when it comes to cloud providers like AWS.
So my takeaway here is the value proposition of the cloud, in particular AWS, is, we're going to take what was previously an inflexible capacity problem, where you had to sink costs into hardware and then also be, hire knowledge workers that are, able to sort of facilitate and maintain this equipment cost and hardware. You're basically cutting all that. And then you're paying Amazon to continually update the hardware and stay on top of the infrastructure, and you get the benefit of only paying for what you need at any given time.
Right. So I have some more charts to show what are the benefits after a company moved from their traditional infrastructure like on-premise to AWS. So they saw, like, after AWS, they saw a 27.4% reduction in overall spend per user, 57.9% increase in VM. VM is the virtual machine managed per admin. 56.7% decrease in downtime. This is huge because now you are not maintaining your infrastructure, and if something goes down, then you have to worry about you managing everything. This is all managed by AWS, and this is the benefits of going there. And then 37.1% decrease in time to market for new features and applications. And this is what will enable all the startups to move so fast and come up with a product within no time, because they are focused on their product and not focused on anything else apart from what they are specializing in.
Yeah, I mean, the value proposition, the return on investment here seems to be pretty clear.
Yes. So I would want to go to the next section here, which is Amazon advertising. And I just wanted to give a background about myself on the advertising front. I work for a DSP. So I work very closely in this space, though I am not um, an expert with Amazon advertising, but I can still provide some commentary on the solution offerings on the Amazon advertising space. And this is one of the most promising thing that I see going forward for Amazon. Um, So the first solution offering here is the Amazon DSP, which is the demand side platform that will enable all the advertisers to programmatically buy your display, video, audio ads, both on and off Amazon. They also offer custom advertising solutions. These are typically for like the bigger clients where they will have these customer experiences across Amazon's online and physical stores with the campaigns from their custom advertising team. Um, and they had acquired a company called Seismic that will tie into this part of their solutions. Um, One other thing that I see is Amazon Live, which is the ability to engage with shoppers in real time and drive consideration through interactive shoppable live streams. This is what I see happening in the future, where people are buying, seeing like someone is talking about that product in live stream, and then you can ask questions to them and then make a decision if you want to buy or not buy that particular product. And then the fourth one is Amazon Attribution, which is still in beta. This is the analytics and measurement console, and that will be very critical for the brands to discover how like non-Amazon digital marketing tactics are helping drive sales on Amazon. So if I am having my campaigns run outside Amazon, I just want to measure how they are doing and how they are bringing those particular customers into Amazon and buying my products. Um, and then there are these ads as well, like the audio ads on your Echo devices. These are the sponsored displays. The CTV, OTT opportunities here are huge because of Amazon Prime Video. They can choose to show you the ads on that platform. And then you have the sponsored brands and products.
Yeah, and on the CTV OTT, we have the Amazon Prime streaming service, but also the Amazon Fire Stick, the hardware as well. And the other thing that I don't see here is, which is a huge opportunity, is Twitch, which I believe has 140 million monthly active users on it. This is that gaming streaming platform that serves up, mid-roll and ads during gaming streams, and is being used by software developers too, to like walk through code, um, you know, coding classes and that kind of thing.
Yep.
Yeah.
Yeah, so I will take this question from Eric at Eric DSS. He says, what was your original thesis for buying Amazon? Where do you see the biggest opportunity when you first bought it? Was it in e-commerce or AWS? Today, has the original thesis changed? From today's viewpoint, where are you seeing the biggest future opportunity in 5 to 10 years? I will talk about the next question and then answer them both together. Chaozam at Chaozam, right, several years ago, an Amazon advertising rep made a sales pitch to our group. He said, FB knows what you like, Google knows what you search, Amazon knows what you buy. And they were thoroughly impressed and included Amazon in their annual advertising buy. And then he says, how important is advertising to Amazon? So my original thesis for buying Amazon was AWS, because that was the time where I saw that we had increased spend on Amazon every month, and we were using their products, and that kind of had me buy those Amazon stock, and it was overvalued at that point of time, and now it is overvalued now too when you have your traditional metrics. Um, and and like it was not e-commerce specifically, it was AWS. And if you see, okay, has your original thesis changed? No, my original thesis has not changed from there. And from today's viewpoint, where are you seeing the biggest future opportunity? I would say India is the next big opportunity here. And also Amazon advertising, which to answer Chazam's question, absolutely advertising is the fastest growing segment here. When you see the others, it was like $1 billion in revenue compared to $14 billion of revenue now. 1 billion was in 2014. In 5 years, they kind of 14x'd the revenue in terms of advertising. What do you think? What was your thesis on Amazon?
Well, the retail business was my, or specifically the operation of the e-commerce business was my thesis. And I don't know if I mentioned this earlier. At the same time that I was working at Amazon, I was touring other fulfillment centers, during interviews and things like that for companies like UPS or Peapod, which is a grocery delivery service. And just walking through those fulfillment centers after having worked full time at an Amazon fulfillment center, there was no comparison. It was night and day. Amazon, even back then, 5-6 years ago, was light years ahead of any other fulfillment or logistics company that I could see. And so, while I still have questions about their ability to remain up to date with the trends, consumer trends in terms of like discoverability of products and that kind of thing. I think that they have a fundamental structural advantage on the cost side that is only going to continue over time, similar to how Costco has operated for so many years. I think it's going to be very difficult for anybody to undercut Amazon on price, like on a global scale. But who knows? The future is unknowable. But as far as future opportunities, I would agree with India and more generally the international business as a whole. The fact that North American revenue accounts for so much of the business, and just considering how large the global economy is, and how many pockets of the world, and how much more e-commerce penetration there is, that we'll go over that in the future, and the fact that the international business is still not profitable and can be turned profitable over the next 5 to 10 years, in my opinion, are big opportunities.
Right, absolutely. And talking about Amazon advertising, right? That's another opportunity that I think is a big thing. I would want to share a slide here, which is Amazon's share of US digital advertising versus the duopoly of Google and Facebook. So if you see from 2016, Amazon was only having like 2% market share here. 41% was Google and 17% Facebook. The market share of Amazon has steadily increased. 2020, this was estimated here at 10%. 35% Google and 23%. And the other estimates are like from 10% in the next 3 years now from here, it will go from 10% to 14%, whereas it's going down for Google and Facebook both. So Amazon is eating their lunch here in terms of digital advertising market share.
Yeah, this is a phenomenal slide, and I haven't done much due diligence in terms of Google, but I can't help but shake the feeling like Google is sort of lost in the woods currently in terms of their focus in general. I know you used to own Google shares.
Yeah, I used to own it, but because of their slowing growth, I just sold that off, and I invested in other hypergrowth businesses. So moving on to the next slide, Daniel Schwartzman at Daniel Shortman, he writes, what are your views on negative effects Amazon has on fair markets, how it treats partners, warehouse and office workers? This is not accusatory, and I have a lot of Amazon friends, but given you work there and that your way ethics, I'm curious.
Yeah, and so Daniel Schwartzman, he's the co-host of the Razor's Edge podcast with Akram's Razor, which is a great podcast that I would recommend anybody listen to. They talk about usually SaaS companies, and usually with a pretty skeptical lens, which I think is a nice counterbalance to sort of the euphoria on Twitter for a lot of these names. So if you ever want a sober take on the markets, I think it's a pretty good place to listen. But I love this question. I'm really glad that he asked this because, like he said, we do weigh ethics when we invest, and I think that's kind of like a cornerstone to like what sets us apart from other folks. But if you want to go to the next slide, I talked a little bit about stakeholder leadership that Jeff Bezos sort of leads with, and I think this is kind of like a controversial take, like maybe not in the investing world, but in the world at large. There's like a backlash against billionaires and like large mega corporations, and for good reason. I just think that when you dig into the details of Amazon, if you read the 10K, the 10Q, the quarterly, shareholder or presentations, what becomes really clear is their focus on conscious capitalism and stakeholder priorities. So, for example, if you open up their quarterly earnings statement, they will, after the financials, the first three categories are titled supporting employees, investing in communities, and protecting the planet. Some of the investments they've made along these lines, and especially since the coronavirus, they've spent, $4 billion of incremental spend on, preparing the warehouse workers for working in a pandemic environment. There's still been outbreaks. I think there's a recent story that said that they had like 20,000 workers get the coronavirus, which is awful. But I just think that there's very few other companies that are spending as much money and just resources in general to help their employees, stay safe in this environment. And with regards to investing in communities, they are paying their workers 95% of the tuition necessary to upskill into higher wage jobs, whether they apply to working at Amazon, like as a software developer or some other kind of skilled labor, or if it's not got anything to do with Amazon at all, like in areas like nursing, for example. Well, cross your fingers, maybe it will be, an area of, expertise for Amazon down the road. And then protecting the planet, we talked a little bit about this earlier, but their focus on being carbon neutral or by the year 2025, I believe. So if we think back to the slide around square footage. So their global square footage of their retail, like fulfillment center space, is 200 million square foot, and total, including international and AWS, is 284 million square foot of leased square footage globally. They're going to be carbon neutral by 2025, so in 5 years, or zero emissions globally, which is humongous. So they're buying EV vehicles for their carrier, for their workers who are doing deliveries, for example. And not only are they doing that, they're like providing a blueprint for other companies and then pressuring them to follow them along, not just with the $15 minimum wage that we talked about earlier, but also in all these other initiatives of supporting employees, investing in the communities, and protecting the planet. So on the conscious capitalism side, I believe, and it's my experience working there too, that they not only talk the talk, they walk the walk. Now, some of the concerns that I have from a moral, ethical standpoint on Amazon, and if I were to sell, likely it would be for one of these concerns. The three of them are worker safety and worker rights, government contracts and artificial intelligence and how they sort of intersect, and then consumer privacy and safety. And I'm sure there's other ones that I'm not thinking of here, but as of today, these are the three that stand out the most to me. So, when I worked at an Amazon fulfillment center, safety was the most important priority every single day. We were practically brainwashed as management to talk about this with employees every day and have zero leeway when it comes to safety standards. So stuff like not having closed-toed shoes, or like letting your hair down below your knees because you have, or not your knees, your shoulders. So, because of the conveyance systems that are around, that kind of thing, pallet jack safety, forklifts, and all this type of stuff. But what's changed since I left is the proliferation of Amazon robotics and the moving shelving space. There's a lot more moving pieces and robotics in the fulfillment centers, which means there's a higher likelihood of serious injury that could occur. And so that's something that I'm concerned about. And as I've read some articles on like The Verge, for example, it seems like that's becoming more of an issue. And then workers' rights, they are notoriously anti-union. They were back when I worked at them at Amazon, and they continue to be. And that's something that when you get to the scale that you're at with 800,000 employees, and the kind of work, the kind of physically demanding work that's associated with making these operations run, they do deserve the right to collectively bargain, in my opinion, and fight for what's important to them. So I those are some of the concerns that I have around that category. Government contracts and AI, this talks about the overall market capitalization. When you're at $1.5 trillion market capitalization and you're looking to grow into a $10 trillion market capitalization, the way you do that is by disrupting or providing services to major industries, so healthcare, governments, that kind of thing. And when your customers go from being consumers to the government, when the vast majority of your revenue is coming from the government, that's a whole new customer that you're optimizing for. And it might be at the expense of that third category, that consumer privacy and safety. And when you add in the power of artificial intelligence and machine learning, and apply it to some of the goals of governments that may or may not be nefarious, you end up with problems of things like discrimination, racial discrimination, gender discrimination, oppression being hard coded into literally code that operates at scale, and becomes very hard to unwind. I think if you've watched The Social Dilemma, you know that at the core of all these companies, at these big tech companies, is an opaque black box that is sort of making decisions that are more complex than any one person can sort of wrap their head around. And it very, very much becomes like a problem that is hard for these companies to get a hold of. And so those are some of my concerns. And then on the privacy and safety side, if you look into some of the issues with Nest and Ring, where, for example, people are hacking into people's homes and, like, for example, speaking to your children through the speaker system of Alexa when you're not looking, pretending to be their imaginary friend. You can Google this. This is like not something I'm making up. This is like really an issue that happened. Those are some of the things that you'd hope that they will clamp down on. And what I would say is that I genuinely believe that Jeff Bezos wants the world to be a better place. I think buying the Washington Post is an example of like that good faith that he's trying to put forward. And I think he's a Darwinian person, and Amazon's a sort of like a Darwinian organization, but they're also ultimately open to criticism, both externally and internally. And I've known from firsthand experience that it's a place that is capable of change, and change for the better. And I can't say the same for a company like Facebook. But anyway, I've talked on and on here, but any thoughts on that, Deval?
So I wanted to highlight a few things here on the conscious capitalism side. You mentioned that Amazon was on path to run on 100% renewable energy by 2025. Their actual goal was to do that by 2030, and they are 5 years ahead of that schedule, which is tremendous.
Yeah, it's incredible.
Yep. And one other thing I wanted to highlight here was they provided a 500 million overall, like a total thank you bonus for all their frontline employees, which were with the company through the month of June. That's a great thing from Amazon.
Absolutely.
Yep.
Yeah. Um, yeah. So let's move on to the next slide.
Okay. So Jesse Krieger, J5, he writes, when do drones become normalized in everyday shipping / receiving life?
Yep. Yeah, and it's kind of a funny question in the world that we're living today, like where it's not happening basically at all at any meaningful percentage. But this question has been answered or thought about by ARK Invest, and they released this graph and a larger article on their website the week of I think it was March 13th of this year, which is the week of the lockdowns in the United States for coronavirus. And it's interesting to look at now. So you can see the 2019 e-commerce breakdown, 15% e-commerce as a percentage of overall retail. And then their projections out to 2024 and 2030. So they had projected by the year 2024 that 32% of retail would be e-commerce, 62% would be just regular retail as we know it today, and then 6% would be drone delivery. And then by the year 2030, 25% would be e-commerce, 35% of it would be drone delivery, and then the rest of it would be 40% would be retail. Now, I would just like pause to just say, ARK Invest, obviously I post the daily ARK trades and a lot of people know me for that. I also, I don't follow them like religiously, I'm also a critic of them. And I would say that generally one of the criticisms you could say about ARK Invest is that they are pretty hyperbolic. They exaggerate, some of the disruptive innovation that they are keeping tabs of, generally speaking. And a lot of these projections tend to be way more aggressive than I think most people are comfortable with. But what's interesting about this is that since the coronavirus has proliferated, if you go to the next slide, this is a slide that sort of made the rounds. You could see that this is the penetration of e-commerce as a percentage of retail sales in the United States. And what you can see is it took 10 years for the penetration to go from 5% to 16%, stopping in March 2020. And then the 8 weeks prior to April 2020 or May 2020, it grew an additional 11%. So as of April 2020, e-commerce penetration, according to Bank of America and the U.S. Department of Commerce, is at 27%. So if we go back to the previous slide, that 32% percentage of penetration of retail sales by 2024, we're already at 27% now, or as of April. So I think part of the thesis here that ARK was trying to make is that as e-commerce proliferates and becomes more normalized, the public appetite for drone delivery becomes more acceptable from a regulatory framework and from a consumer demand framework. So if we're already at 27% e-commerce penetration and we're living in a coronavirus world where people are more conscious of contactless and touchless payments and delivery, I think it's an even more favorable environment for drone delivery than it was when ARK Invest put this together. And so what was once an exaggeration or hyperbolic might actually just be what we should expect, So 6% drone delivery by 2024. I don't know about you, but to me, that sounds actually relatively reasonable. And so let's take a look at what that actually might look like in terms of drone delivery.
This looks like they totally nailed it.
Yes. So I think it's important to think about drones in all their different formats and how it might make sense in different contexts. So I live in an urban environment. I live in Chicago, and Deval, you live in Jacksonville. I don't know if you live in an urban part of Jacksonville or suburban part. Um, but I don't know. But
Yeah, it's a suburban part.
yeah, so I know about for where I live and how densely populated it is. I don't think it makes sense for flying drones to do parcel delivery to everyone at any time. Regardless of the context. There would be too many. These drones are really loud. I don't think that that's going to change, to be honest, in the next 10, 20, 30 years. So flying drones, I think, in urban areas are less likely unless if, it's like an emergency, like maybe you need medication. I can imagine a situation where like what we, in the same way we have window units for our air conditioning, we could have a window unit for a like drone landing pad to drop off like medication if in case someone's maybe like having a heart attack and you don't have the medication on you, for example. I could see that happening. But to deliver your lunch, I don't think it makes sense to have a flying drone do that in an urban environment. But I could see, in the bottom right corner, these drones that are, on wheels, driving on sidewalks, going up to your door, restaurants putting the food in and getting it delivered to you. Or on the bottom left, if you've been familiar with Boston Dynamics, it's a sort of like walking dog type of drone. These are able to walk upstairs too. So I could imagine, an autonomous sort of van with parcels on it, and then one of these Boston Dynamic type of drones walking up a flight of stairs and delivering something to your door, whether it's food or whether it's a parcel. But I think that the flying drones are more likely to happen in suburban or rural environments for package delivery and maybe even grocery delivery. But anyway, that's the vision that I see from today to the future with drone delivery. Any thoughts on any of that?
I totally agree on that. Drones, you also have to consider the safety
Mm-hmm.
as well. And drones, at least as of now, are not considered to be as safe as we hope to be.
Yep.
But I would see them like in the next 10 years to be a norm in sort of delivery where there are no or less safety issues like in suburban areas where not many cable wires running through the
Yep.
streets and much easier to deliver the packages.
Yep. And so just a couple companies for people to look into here if you're interested in drones as a investing play for the future, which by the way, I don't own any of these stocks, but at the top left corner, if you this product here is or this drone is manufactured by a company called AeroVironment. This is ticker symbol AVAV, and it's part of the ARK Invest portfolio. And it's a defense contractor kind of company that I guess the idea is that they could pivot into more commercial or consumer applications. On the top right is an interesting company called Workhorse. And so this is an EV company based in Ohio, I believe, and they have a contract with like UPS and a U.S. Postal Service to make EV delivery vehicles that also have like a drone basically hatch at the top of the van that could help deliver parcels in the way that you see them right there, with like a chain that could drop off the parcel without landing. And the bottom left is Boston Dynamics. There's tons of videos. You've probably seen them already of people kicking the dog robot and then it getting its balance back together. They're pretty creepy. And then the bottom right is not managed by this company, but this company uses this technology, and this is takeaway.com or Just Eat, which acquired Grubhub. I used to work at Grubhub prior to the current company that I work at, but it just shows them piloting this technology. And this is the Just Eat or Takeaway.com is a European company that just got a foothold in America through the Grubhub acquisition.
Right. All right, so moving on to the next question. This is from Investment Talk at Investment Talk, and he writes he would want to see a discussion on our thoughts of their physical store allocation, including Whole Foods. Um, so I'm going to list down these stores or physical footprint that they have. They have stores like Amazon Books, Amazon 4 Star, Amazon Go, and they have these Amazon pop-ups and the Whole Food markets. So this stats is from a website called Statista. And if you see, they had a total of 607 stores, and as of July 2020 they have reduced these stores from 607 to 589. The Whole Foods stores have remained consistent, like 500 stores, and no change at all. But the major reduction is in the Amazon pop-up stores, went down from the 80 pop-up stores to 7. These pop-up stores are those are like temporary stores that will sell all the Amazon merchandise. But yeah, I would see that these pop-up stores will eventually go away. Anyways, there are only 7 from the 80. Um, so yeah, what I am most bullish about is their technology called Just Walk Out. Now, what this technology does is you enter a store with your credit card, and then you shop, and then you just walk out, and then you just get billed on your credit card. It will automatically detect the aisle from where you pick the item and what is the price, and they will just charge you. You don't have to stand in lines and wait it out. Now, what this technology is for is what Amazon is trying to do is they are trying to have all the other stores use this technology. So the stores are not managed by Amazon, stores are managed by the companies, but the technology is what is provided by Amazon. So this is what I think about Amazon moving in the future to enable others do better in terms of their store footprint and be much more efficient, and maybe we'll collect a lot of data from this. I don't know, but we'll see how it goes. What do you think about this?
Yeah, I think it's as a shareholder, I'm like amazed at their ability to continue to innovate. And I've gone to an Amazon Go store where you just scan your app off your phone and walk in and pick something out and just walk out, and then it just charges you. And we've seen the technology recently where you just like show your hand and then it does the same. Moving it out into like a platform for SMBs to use, I assume, or medium or enterprise companies even using as well,
Right.
is a powerful proposition. But I have to be honest that it's a little bit creepy, in terms of like just the technology itself, and also just like what it means for the economy moving forward. Just a concentration of power, further concentrating power to Amazon. I think that if it works properly and if people accept it, like consumers accept it, I think that it'll, the companies that do use it will be at an economic advantage to the companies that don't, because you'll have a significant cost advantage of not having to staff, cashiers and that kind of thing to operate your business. But at the same time, you're forfeiting, maybe the customer relationship. So I think Shopify comes to mind. In terms of like their value proposition is maintain your customer relationship. I think that some retail businesses will still want to maintain that customer relationship, even if it means they have to staff their own cashiers and things like that. So those are some of the my thoughts in general. Anything on that?
No, I think I'm just curious to see how this pans out, and this is one thing I would be watching from Amazon. Um, so moving on to the next slide, I wanted to highlight a few words of wisdom from Jeff Bezos. And this is one thing that I really liked about it, and I wanted to put it here for our listeners. I would just read it from the slide deck. He says some decisions are consequential and irreversible or nearly irreversible, which are called one-way doors, and these decisions must be made methodically, carefully, slowly. If you walk through and don't like what you see on the other side, you can't get back to where you were before. We call these type one decisions. But most decisions aren't like that. They are changeable, reversible, they are two-way doors. If you have made a suboptimal type 2 decision, you don't have to live with the consequences for that long. You can reopen the door and go back through. Type 2 decisions can and should be made quickly by high judgment individuals or small groups. Now, this is one thing, one advice or one snippet which I really feel for, like this can be applied to all the facets of life. This is not just for investing, but anywhere you go, you can apply these kind of thought process where you can um, make those decisions in in a way that you can make it quickly if they are changeable and reversible, but you have to go slow when you know that those are irreversible decisions.
Yeah, I agree that this is applicable not just to working, although it resonates heavily with what it's like to work in a large company and how it would optimally work. Being able to move fast and I think that like when the Fire phone comes to mind here, where they went into that business and they decided that, hey, if we fail, at least it's a reversible. At least we tried it and we're going to learn from it. Even though we did it.
Right.
Um, so yeah, um, I'm happy to go through the next one here. So this is the one that comes to mind for me, especially in the investing context. When I'm the way that I try to invest is to invest in high conviction companies with high concentration and hold for a long time. And in order to do that, you need to make some like hard decisions about not just what you're going to invest in, but what you're not going to invest in. And I think like making that determination, this framework is helpful. So he says, I almost never get the question, or I'll start a little higher. I very frequently get the question, what's going to change in the next 10 years? And that is a very interesting question. It's a very common one. I almost never get the question, what's not going to change in the next 10 years? And I submit to you that second question is the more important of the two, because you can build a business strategy around the things that are stable in time. And then the last sentence here is, when you have something that you know is true, even over the long term, you can afford to put a lot of energy into it. And so that's the quote. And a lot of the investments that I have, I feel like I can sum up what that is, that thing that's not going to change in the next 10 years. And the one that I keep coming back to all the time nowadays recently has been Okta, the idea of identity access management, being just something that's not going to change. We've always had IDs in some form or another. And the need to make that a better experience for people is not going to change. So whoever can get ahead of that and make it simple and easy to use, I think has a huge opportunity ahead.
Very true. So we have come to the end of this episode, and as usual, we give out a shout out to the Twitter accounts. So this week, I want to give a shout out to Muji at Hypergrowth. His Twitter handle is at Hypergrowth with 3 H's. And I have known Hypergrowth Muji since the Sal's Investing Board. I've been following him since last couple of years now, and I know that he runs a very concentrated portfolio, maybe around 6 stocks, and the couple of blog posts that he wrote were phenomenal. The last one was the Snowflake deep dive, which allowed me to understand that business in a very, very detailed way. And what are the edge networks was also one of his very good work. So highly recommend Muji at Hypergrowth.
Yeah, Muji's a great follow. Everyone should follow Muji, and I've learned a ton from his posts. And so my recommendation or shout out for Twitter would be Dennis Hong. So that slide where we showed the e-commerce penetration in the U.S. At 27% since coronavirus, that 10% increase over 8 weeks. Dennis Hong sort of shared that on Twitter and sort of made that go viral. And he's very approachable on Twitter. He shares a lot of great insights. Just a little bit of background around him is he's the founder and CEO of Shaw Spring Partners, which is a young investment fund. I talked a little bit about holding in high concentration with high conviction, and he's the perfect example of that. I'm pulling up Whale Wisdom now. He's got 6 holdings in his portfolio that he manages. And in that portfolio, 20 or 30% of it is Interactive Corp, 25% is C Limited, and 20% is Square. So he holds in high concentration with high conviction. Well, everyone, thank you so much for tuning in. This is a little bit of a longer one, but I think there's a lot of really good information that I know that Deval and I are really proud of the work that we put in on this one. So we'll be posting this on YouTube and through our podcast channels. So please reach out if you have any questions or comments. And until next time, we look forward to hearing from you all again.